everybody. Thanks for having me. Nick Livigne, head of product for Convene. Convene is a network of premium places to work, meet, and host inspiring events. We tend to partner with landlords. Our number one stakeholder is landlords, and we tend to operate out of Class A office buildings, really working on being the premium product in the market. Convene was really started by trying to answer the question of, what if you operated an office building like a full-service hotel? And the beginning of that thesis was started to be proved out 10 years ago. Actually, this month is the 10-year anniversary of Convene, which is amazing. And really, the beginning of it was on the meetings and events side. So we took over a large conference center that was on the books, a full lease by TIAA CREF, and we took that from them and said, hey, what if we operated this for you, gave you a really good rate, and you can use it dynamically when you need to, but then we would sell it out to the outside on a dynamic basis in the market. So that was really the beginning of Convene. And then we recently have gone in, over the last 18 months, moved into the flex office workplace market, and we're able to scale on top of that, scale on top of the meetings product because of the basis of the infrastructure that we were able to build there on hospitality, food and beverage, culinary. We can scale that into the workplace product and provide a premium experience there. So as head of product at Convene, my role is really focusing on making sure that our product keeps pace with our growth, and we continue to provide a great premium experience, hospitality-focused experience within both of our products, and all of the kitted parts and typologies that need to be built in order to build scale, allow us to build our locations consistently, but with unique components that are reflective of the local market, and continue to provide that great experience.
Awesome.
Thanks. Hi, everyone. Thanks for having me. My name's Ari Kantrowitz. I'm the general manager for the Bay Area for Knotel. So Knotel is the leading provider of dedicated, flexible office space with a focus on tailored spaces for enterprise. So we're focused really on serving Fortune 1000 companies as well as growth stage companies that need a fully dedicated, flexible office solution. And the focus is really on turning CapEx into OpEx, so companies are able to invest in their core business and not have to worry about real estate. So we'll work with a company to identify their workplace strategy, their brand requirements, and their broader real estate portfolio needs, and provide them a global, flexible platform for their headquarter requirements. And we're really exclusively focused on that space. We started with a smaller floor plate strategy, focusing really on earlier stage growth companies, and quickly found that the product market fit with enterprise companies is actually incredibly strong. So we've since pivoted to focus really very, very directly on that space, and really just building a lot of depth in the top global real estate markets in the world to be able to create that flexible platform that enables one of our customers to have a flexible office space with us in San Francisco, but then also very quickly open an office in London, and knowing that it's going to be fully taken care of, fully tailored to their brand with very clear standards and operating guidelines.
Awesome. So let's start with a very general question, guys. Like, what is flexible office space, and why are people using it so often right now?
So if you look at sort of what a traditional office space looks like, you're engaging in a 7 to 12 year lease, you're engaging your own workplace strategy, you have a tremendous amount of CapEx associated with build out, with fit out, ongoing management expenses, you have a very large real estate team to manage all of this. And then you look at how businesses are actually operating today, you've got a 1 to 2 year headcount plan and maybe a 2 to 5 year capital plan that's completely misaligned with the length of a traditional lease. So what we're doing is we're enabling companies to really focus on the needs of their business as it exists today and in the near term, and have the ability to flex to larger, smaller office spaces globally. So, and if you look at the research, the incumbents, JLL, CB, they're postulating that flex office is going to be anywhere from 15 to 30% of large company real estate portfolio within the next decade. So this is something that's here to stay, and it's something that we're really excited about being able to service.
Yeah, and I'll just add to that you see an increasing trend, the relationship between the worker and the organization. Large companies that care about attracting and retaining the best talent need to provide more and more experience within their workplace and more connections to the brand within what the workplace represents. So we like to say that the physical workplace is like the body language of an organization, and how you treat your employees within that really matters. And when you try to match up flexibility of term, no upfront capital, and the pressures that a real estate leader has in that regard, and also trying to provide experience, we feel that the only way to do that is through some type of flex office, co-working, shared workspace solution with all of those amazing experiences baked into it. So there's a lot of things that are kind of leading us in the direction of feeling very confident in this sector, and the idea that all those things are not going away. The trends are moving further in that direction.
Yeah, I think to add on to that, workspace is a competitive advantage.
Absolutely.
Right, and the ability to deliver that's going to impact your ability to attract talent, especially in a city like San Francisco or New York, as an example.
Yeah, I think it's also important to point out that 15 to 30% of the workspace market, let's call it,
Right.
it's a massive TAM. It really globally is, I think in the discussion we've had around WeWork in the past couple of months, people forget that this is just an enormous market where there's a huge revenue opportunity. And to that end, I want to sort of draw the connection for people. Somebody I was talking to earlier today was saying, oh, but I only spend $400 for my desk at Convene. How can that be a good business? And actually, for you guys, your key customer is the landlord.
Yeah, that's right.
Yeah.
So, like I said, our number one stakeholder is the landlord. If you look at what landlords are trying to solve for today, they have higher churn rates. The term is dropping. I mean, we're now seeing renewal rates below 50% in some markets, and lease terms have dropped to below 7 years. And you think about them having to reinvest capital into those spaces every single time through TI, and then also the demand from their potential tenants to have a fully amenitized building. We at Convene are going to landlords and saying, we can solve that problem for you. We can do it through our amenity management platform, our experiential retail. We have partnerships with cafes and so forth to provide amenities into the space. Our meetings product specifically, which is dynamic used meeting and event space, is seen as an amenity to tenants in the building as well. And then our workplace can kind of act as a lung for organizations throughout the building that want a third space to send their people to, or need an extra team room to help with some of their growth. And it really positions, our product is positioned for a landlord as our key stakeholder to solve a lot of those problems for them.
Yeah, I'd say we're, very similarly maximizing asset utilization on the landlord side and really accretive to the value of the underlying asset in the building by bringing in really strong logos with really strong retention and low vacancy.
Yeah, and I think, when I think of Knotel, I almost think more of like a two-sided marketplace.
It is.
And I think that's an important thing for us to remember about these type of businesses. So what do you see that's motivating then customers to look for, and by customers I mean users as opposed to landlords, to look for sort of co-working or flexible office solutions right now?
Yeah, I think again, it's that reticence to make a super long-term capital commitment when their capital and headcount plans don't align with that.
Yeah.
So having that degree of flexibility is huge. If you're Microsoft, you want to set up a 100-person engineering office in New York, and you can either do this very quickly in the 3-month to 6-month time frame with us with no capex up front, or you can engage in a long-term real estate process and make very significant capital investment. So there's the speed to market element. There's the element where you don't have capital outlay. There's the element where, again, against that plan, if you're in a lease that doesn't work 3 years down the line, you're going to have to write down that asset, and it's going to be EPS dilutive. So there are all these benefits to moving CapEx into OpEx and really having more of this sort of subscription basis, and also having the network that you can flex within and a platform that's global.
Yeah, you made the point when we did our prep call also that big tech companies are now using contractors.
So we discussed that. So if you look at Google as the example, it's almost a 1-to-1 ratio of full-time employees to contractors. So if you're thinking about the expense that a Google is putting into their headquarters with all of the amenities, all of the food service, all of these things, it's incredibly expensive, and they don't want to incur that cost for their contractors, understandably so. So they're actually moving towards flexible space adjacent to their headquarter operations to support all of these contractor operations. Amazon's doing the exact same thing in Seattle, for example.
Yeah, and the point of contractors is to build flexibility into your labor model, and you need to match that with a real estate strategy as well. So I like to use the example of like an energy grid in terms of base load energy is the consistent need for energy across that grid, and then you have peak loads through different sources that are more variable that meet the needs more on demand. And we can kind of think about the same thing in terms of a traditional lease. I don't think traditional leases are going away. Campuses are not going away. How they're managed might change a little bit, but those assets are not going away. But the idea of peak demand and flexibility is really where the flex office space comes in, and to try to fill that need.
Yeah. So there was a lot of discussion around WeWork in terms of WeWork's real asset exposure and the risk that created. How does that factor into the models that you guys have?
Yeah, so we're a super capital efficient business at a 4-to-1 advantage of what that competitor is doing. So we're just very, very diligent.
Like the use of that competitor.
We're very diligent about our capital decisions. So we're not, again, we're looking to go deep into markets and really understand markets. We're not looking to just acquire top line square footage and top line ARR. We're focused on under the line. So we're really looking at EBITDA and down to individual property profitability in a very disciplined way. So we're not just going to go acquire a ton of space on spec and then just hope we can fill it. We're very strategic about how we approach it, and that's one of the things that we leverage technology to do.
Yeah.
Yeah, and for Convene, it really goes back to our partnerships with our landlords. We really align ourselves with landlords that understand that having a Convene in their asset is accretive to their asset. And so we're able to drive below market rents where we do have straight leases, which, by the way, 21% of our spaces are under a management agreement, whereas the remaining 79%, some of them are straight leases, more legacy deals, but others are structured leases or creative structures that allow the landlord to actually participate in the upside. And so all of that together kind of really allows us to be asset light. We get more capital from the landlord to build out space because they're seeing benefit on the back end, and it allows us to be much more efficient in how we allocate our capital.
So, both of your companies have raised venture style equity, and both of you. How do you think the venture style expectations around growth and the pace of growth that align with real asset exposure? Like, how do you think it's going to work for PropTech?
Yeah, so I met with one of our board members yesterday, and we were talking about it, and again, laser focused on property level profitability. So I think the broader focus within venture now is shifting. So we've had a number of very large IPOs that have been really disappointing. I was part of one of them. Previously, I was at Lyft. So I think sort of the expectations for how companies are going to be evaluated by capital markets is changing. And there's going to be a focus, if not on immediate profitability, at least on a very clear path to profitability. And those are the conversations that we're having with our investors. Those are the conversations that we're having in the capital markets as we continue to raise funds.
Yeah, the thing our investors are most excited about is our unit level economics. We're operating north of 30% margin on our locations, and our in IRR is north of 30 as well. So the way that we operate our business, even historically, we have been cash positive as a business. This current calendar year, we are not, as a conscious choice to grow, but next year we will return to company-wide profitability. And our unit economics, our CFO likes to say that we have all of the indicators of a really exciting growth company, but with all the boring metrics of a company with stable unit economics.
Awesome. So I'm going to open it up to the audience. If you guys have questions about this space, I have more I could ask as well. So anybody out there? Come on. Okay.
This is you or me?
I was first.
Oh, go ahead.
Also, you guys are customers of his business, so you're going to get a softball over there. But I'm curious about the shift in commercial to contemplating management agreements and residential in the STR space is happening very rapidly with a ton of enthusiasm. I've heard nothing of the sort in commercial around people asking for management agreements. Clearly, both of you, have some experience with this, but walk me through just the current psychology of a typical Class A, Class B commercial owner and their thoughts about management agreements.
Sure. So our head of real estate can speak about this much more eloquently than I can, but the way that we talk about it is it depends on the ownership structure. So there are certain rules around REITs that restrict them from recognizing certain revenue other than straight leases, which is durable revenue. So it depends. Our real estate team will talk to the landlord directly to understand their capital structure, so we can fit into that. So management agreements are a bit more difficult with certain ownership structures, but what we're starting to see is that because of all the things I was talking about before, where they have to provide an amenitized experience and there's a lot of churn within the building and deploying capital, they're coming to us to start to act like a front of house for their brand. And we talk about this a lot internally, where we see the future of commercial office space as looking a lot like the relationship between management and money in the hospitality space. So Hilton and Marriott, they don't own any of their buildings. If it maybe 1 or 2% they own their buildings, where they work directly with the REITs and the landlords to manage on their behalf, because the flag gets you the res network, the brand recognition, and so forth. And we're seeing the same kind of trends moving in that direction, where experience becomes much more important to the day-to-day tenants in the space, so brand becomes more important. And then opening up the funnel to opportunities on the res side, like the equivalent of a res network is kind of where we're going.
And I'd add, so in addition to the owner profile, the geographic profile matters quite a bit for us. So in Knotel, for instance, in Brazil, we're 100% management deals. In London, we're 20% management deals. In this market, we have no management deals. So a lot of it's going to be driven by broader market dynamics as well.
Yeah, and I think it's also worth noting that, not unlike hospitality, I think we're going to see different brands coming in at different levels to offer different kinds of services. And Industrious is much more heavily weighted towards managed deals than your companies are, but also as a player in the space. Others?
Yeah, so I'm curious from a unit economic standpoint, what's the threshold, like by what percentage can rents go down and vacancies go up where you can still make money, and at what point does that equation break?
Totally deal dependent, I guess. But well, I would just say the good thing for us is that 90% of our revenue comes from non-flexible office sources. So our meetings and event business is not a vacancy type of question. Still the core business and what we build on top of. So. Do you want to take a stab at that one?
I'll take a stab at it. But to your point, it's really the dynamics of the deal matter. So how much down do we have in deposit? How much in TIs did we receive? What's our capital outlay associated with it? How long did it take us to fill it? So there are a huge number of variables that would impact that. Obviously, softening markets don't particularly help that. But then there's sort of the corollary side. If there's a softening market on sort of the tenant demand side, then there's opportunity on the supply side as well. That would, and hopefully would offset that, but it's obviously something that we have our sights on.
Guys, I want to ask you one quick kind of wrap-up question, because I thought your answers were interesting on our call. Are you tech companies?
No.
You
want us to elaborate? We are tech-enabled companies. I would say we use technology deeply in how we build our business to help our customers transact easier with us, to enable a friction-free experience, and to build the back-end systems that allow our people to work smarter and focus more on customer interactions, which is the core of what Convene does. Is hospitality is always delivered person to person, and technology helps us focus more on that.
Yeah, plus one. It's we're a real estate company first and foremost. That again, we just leverage technology to make smarter decisions, to be able to move faster, to crush down the time to sign a lease, to get a customer into a space more quickly, to understand points of leverage, and getting a space built out faster, running parallel processes more efficiently, things like that, and using technology to make the space better for our customers on the tenant side as well. But no, we're managed as a real estate company. Our expectations are to run ourselves as a real estate company.
Awesome. Thank you so much, Nick and Ari.
Thank you.
Thank you.